Hello and welcome to this very special episode of Equity Sahi Hai, an investor education initiative brought to you by Motilal Oswal Asset Management and the Money Mile. Joining me today is veteran financial advisor Sunil Jhaveri, who's also called Mr. Bond. Thank you very much, Sunil, for coming by here to the Money Mile studio and talking to us. Lots of things to talk about, so let me start straight away with the current situation.
Sure.
The investors and large numbers who came in the last 2 years are perhaps for the first time seeing a sharp fall and a correction. Lot of volatility in the market. What is your advice to investors to do at this point of time?
Instead of taking that question in the format which you put in, let me go back a little and explain to the investors as to what should be the right way of investments and what should they understand to start with. If you show the picture which I have sent to you in terms of one person trying to cross the road in a zigzag manner, not on the zebra crossing, versus another person who's actually crossing the road based on the signal, when it turns green, which one would you think would be reaching the other side safely? Naturally, the person who respects the signals. So I would like to tell the investors and the viewers that you please respect the market signals. Market is always giving you signals on a regular basis. So I have divided the markets into 3 zones: the red zone, yellow zone and the green zone. The red zone being the most expensive zone. That's when the signal asks you to stop. You also need to stop and take a stock of your investments at that point in time. Yellow zone being a reasonable zone where you can continue to stay invested or invest also. And the green zone being the most cheapest zone where, that's where you should be investing maximum amount of money, either through SIP portfolios, lump sum, etc. So if you respect market signals, markets will respect you back. But if you ignore fundamentals, markets will give you a reality check, which is currently happening.
A lot of investors went through the systematic investment plan or SIP route, as you mentioned.
Sure.
So at this point of time, I keep seeing on social media a lot of people talking about, should we stop our SIP right now because markets are falling?
Correct.
And the whole idea of an SIP is to accumulate more when markets fall.
Correct.
At least for the SIP investors, would you say that irrespective of the signal that is coming, if you've got into the discipline of investing, continue with that?
Absolutely. I tell my investors and my audiences when I do investor awareness programs that you should be extremely happy if the markets are correcting and your SIPs are happening. Because intention is not to collect less units, intention is to collect more units for the same amount of money. To give you an analogy which the investors would understand, if I was to buy 10,000 rupees worth of gold every month, this month I get 10 grams of gold and the next month the gold prices fall down and for same 10,000 rupees I get 12 grams of gold. So as an investor, would you be happy to accumulate 12 grams of gold or 10 grams of gold? Answer is very clear and very logical. But unfortunately, investors don't understand that more units is better than less units. So they start to panic during these kind of volatile times and they stop their SIPs. Instead of that, I would only recommend to them that they should continue their SIP. If at all, they should increase their SIP values during such times, because intention, your goals are 10 years, 20 years and 30 years away. By looking at your portfolio on month basis and being very happy that the markets have gone up and your portfolio is growing, on the contrary, over 3 years or 5 years, if the SIP valuation is going down, you should be extremely happy, because that market cycle of 5 to 7 years, by accumulating more units during these periods, it will take you to a different level altogether. So the advice is to the investors currently, those who have invested and not seen corrections so far, continue your SIP or add on to your SIPs.
What is asset allocation and how would you, since you explain things in a very simple way, how would you explain asset allocation to our viewers?
So, let me explain to you in a different language. I say that the investors are like Abhimanyus who are stuck in a Chakravyuh of equity investing because nobody has given them an exit strategy. Just like Abhimanyu was stuck in a Chakravyuh and did not know how to exit out of that Chakravyuh and he fell prey to that. Similarly, our investors are falling prey to this on a regular basis because nobody is speaking to them in language which they understand. When do I do profit booking, exit, etc. What does asset allocation do? Asset allocation just does the opposite of what the investor behavior is.
Okay.
Investors, they buy equity when the markets are on an upswing, and at the peak, maximum investors come into the market, especially the retail investors. Asset allocation does just the opposite of that. Based on the valuation, they will increase equity allocation when the markets are in a correction mode, based on the market PE, PB, whichever is the matrix which they use. And when the markets go into the expensive zone, from green zone to the red zone, as I've explained to you, they will start reducing equity allocation and come back into debt. So there is constant profit booking happening. They are doing buy low, sell high, versus the investors doing buy high, sell low, in which they are currently in the same situation of buy high and sell low. So that is what asset allocation does for you.
How often should you rebalance, is what they call it, rebalancing your portfolio, this adjustment of, one asset class having gone up and one having gone down. How often should an investor do that? Or is it better that you pick your schemes, because normally if you bought, say, a balanced fund, probably it would do that for you. But there are investors who are buying either only debt funds or buying only equity funds. So how do you do this, and how often do you do this rebalancing?
If you were to do it on your own, the ideal thing is that even if you do every quarter rebalancing, it's good enough for you in terms of asset reallocation between debt and equity. But ideally, retail investors should be going into what we call rebalancing funds and not balanced funds.
Okay.
There is a distinction between balanced funds and rebalancing funds. Balanced funds have an exposure to equity which is 65 to 70%, and it gets stuck there irrespective of where the markets are going. But rebalancing funds actually do rebalancing between debt and equity from 30% minimum equity to 100% maximum equity. And those are the schemes which will do either rebalancing on a daily basis. There are schemes which do daily. There are schemes which do every fortnight. There are schemes which do every 45 days.
What are these schemes called? Could you name a few?
One of them is Motilal Oswal Dynamic Equity Fund, which is a rebalancing scheme which does rebalancing.
So the dynamic category
dynamic
is the one
or a
which
balanced
does
advantage
balanced
fund.
advantage or dynamic?
Or dynamic. So these are the two categories which fall under this.
They do the rebalancing on a regular basis.
Absolutely.
So you don't need to worry about doing it yourself.
No, you don't need to do that, because individually you may not be able to have that discipline which the fund house will have within the scheme.
When markets are volatile, there is a tendency, we talked about SIPs, to stop your SIP. There is a tendency to do exactly the opposite of what you normally do in your day-to-day life, that there is a discount out there, you go and rush and buy.
Right.
But when it comes to equities, that doesn't happen.
Yeah, you run
Are you
away.
seeing a behavioral change in people in the last 2 years, or is that part of our behavior still stuck where it used to be?
No, fortunately, I think there is a change and there is a shift in terms of understanding the markets, understanding the nuances of the market, understanding the signals of the market, because mutual fund industry has done a lot of work around that. I'm happy to say, yes, it's not really as irrational as it used to be, the investor behavior. Earlier, at the current juncture, I'm sure many of the investors would have exited from here. Hopefully, this time around, they will understand, appreciate, and instead of exiting, they may increase their allocation to equity as an asset class.
Sunil, one of the questions we get a lot from people is that how much equity should I have in my portfolio? And while there is this 100 minus your age formula, would you go with something like that? Because again, that's too general, isn't it?
Correct.
So how do you figure out that how much equity do I need in my portfolio?
Let me answer it in a different way. Like if you were a conservative investor, you become the most aggressive investor when the market is going one way up. And I've seen that happening in my, when I manage the investors' portfolio, and the most aggressive investors became the most conservative when the market was against them. If I were to ask you to remove a 500 rupee note and throw it out of the window, would you do that? I'm sure you would not do that. Even that 500 rupee pinches you. So what I'm trying to get the message across is that any loss in any investor's portfolio will pinch them. So there is nothing like age minus your 100 minus your age, and then that is the allocation to equity. The ideal way to do equity allocation is based on valuation. Markets have been giving us these mantras like buy and hold, sip karo, bhul jao, do not time the market. Frankly speaking, I'm not a believer of that. You need to time the market to the extent that if you show the audiences the data which I have shared with you in terms of what happened in the green zone, what happened in the yellow zone, and what happened in the red zone, if you had invested in Nifty as an asset class, held it in the green zone for 5 years. You define your green zone. It can be 16 PE or less, that's your green zone, well and good. It is 18 and less, that's your green zone, that's also good enough. But have a discipline in your portfolio. Once you understand these signals, you have discipline in that, and then you switch between various asset classes, which can be dynamic equity fund to pure equity fund, or pure equity fund to dynamic equity fund based on the valuation. And these should be predefined. It cannot be in haphazard manner saying that, oh, I think the markets are overvalued, so let me exit. It doesn't work that way.
Again, a lot of investors tend to make the mistake of investing in mutual funds for dividends. And they think that if I'm getting a dividend, I'm getting a bonus.
Right.
And that's really not the case. But yet you see a lot of investors, prefer to invest in dividend plans. Maybe they're told to do it. Maybe they are under the impression that I'm getting money back. Would you say strongly that if you are in a mutual fund, you rather look at a growth option vis-a-vis a dividend option?
110%. Dividend, what investors don't realize is maybe return of their own capital. So I had done one analysis because last 1 year, last 2 years back, people were guaranteeing, so to say, 1% return from balanced funds. And that was the theme, and based on which the balanced funds AUMs grew. And I had written an article at that point in time, and I had shared that article where I had taken an example of a balanced fund, Birla 95 as an example. From 95 onwards, if you were in a growth option and doing an SWP of 8% versus you were in a dividend option. From 95 to now, you have received 10 crore rupees as dividend from that scheme, and the current value of that scheme just a few months back was about 10 crore rupees. So you're very happy that I got 10 crore rupees back on 1 crore investment as dividend, and my current value is still 10 crore rupees. But did you need that 10 crore rupees as dividend over the last so many years? It was an average of 50 lakh rupees dividend per annum on a 1 crore investment. Your requirement was 8 lakhs or 10 lakhs per annum, not 50 lakhs. But if you were in growth option and you had done 8% SWP from there on same 1 crore investment, you have withdrawn 1.65 crores to 2 crore rupees as SWP, and the current value of that scheme, as I said few months back, was 49 crores. Huge
from 95 to now.
From 95 to now, 10 crores versus 49 crores. Because you are eating that dividend away which was not required. B, dividend is only from those realized profits by the mutual fund industry. And because they have to declare dividend, they have to perforce do some profit booking also, which the investors don't realize. And many a times it is given out of their reserves, and you may have invested now, but you are getting it back from your own principal. And if the market is going down right now, where will they give you the money from? One of the AMCs actually skipped all 12 dividends in their MIPs in 2008-9. Now imagine monthly income plan. What would investors expect? Feeling was I'm going to get every month.
Right.
And all 12-month dividends were not declared.
You mentioned SWP and the systematic withdrawal plan. Do you think that's a great tool for people who have just retired and who want to depend on some money, or those who are not in a salaried job but they want to use their mutual fund to also get some monthly income for their spends?
Absolutely.
Is that a great tool?
I am the one who has been shouting from the rooftops and telling the CEOs of AMC saying, do away with dividend option. Let there be only growth option and let there be only SWP. So I was the one who recommended that you should have a waiver of exit load from SWP, because there are exit load issues also if you exit within a year or so. Most of the fund houses have taken that suggestion, and up to 10 to 15% on a yearly basis SWP, there is a waiver of exit load. Having said that, SWP is the ideal way for anybody who wants regular cash flow. In the debt scheme, beyond 3 years, if you want cash flow, SWP is the way. In equity, 1 year and later, SWP is the best way of doing your cash flow management. It's a cash flow requirement, it's not a dividend requirement. Please understand that. So whether it is a senior citizen, anybody who wants a cash flow for whatever reason, get into SWP, do not depend on dividend payouts.
And how is it more tax friendly?
Let's assume that you have you need say on a 1 crore rupees, you need 1 lakh rupees on a monthly basis, so which is 1% per annum, 1% per month. You are only redeeming worth 1 lakh rupees of investment. So that means if your NAV is 10 rupee, you are only redeeming 10,000 rupees worth of units, on which your NAV may have gone up by 10 paisa.
Right.
So that means 10 paisa into 10,000 is only 1,000 rupee is your short-term gains tax, on which you will pay 30% tax, which is how much? 300 rupees. So that's how it becomes tax efficient, because that entire 1 lakh which you are withdrawing as cash flow is not taxable. So there is an implication of short-term and long-term gains tax issue, but on a long-term basis, SWP is far tax efficient way of creating cash flow for yourself. And I was the first one who recommended that SWP from Balanced Advantage Fund, Dynamic Equity Fund should be the way for senior citizens.
It's been a pleasure talking to you, Sunil. Thank you very much for joining us.
Thank you so much for having me over.
Thank you.
Thank you.
Good.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.